The silver market may look stronger than it has in years, but beneath the surface, powerful risks are building that could change everything. While many investors are focused on rising prices and bullish forecasts, the smartest participants are asking a different question: what could stop this rally? In today's discussion, we'll uncover the biggest threats that could interrupt, delay, or even reverse the silver bull market. From global economic shifts and central bank policies to investor psychology and industrial demand, these are the critical factors every silver investor needs to understand before making their next move. One of the biggest mistakes investors make during a strong silver rally is assuming that every decline signals the end of the bull market. Financial markets rarely move in a straight line. Even the strongest bull markets experience periods where prices pull back, confidence weakens, and headlines become overwhelmingly negative. These temporary setbacks often create fear among newer investors, while experienced market participants understand that corrections are a natural part of every long-term uptrend. A healthy correction serves an important purpose. It removes excessive speculation, cools down overly optimistic sentiment, and allows the market to build a stronger foundation before attempting another advance. Without corrections, markets become overheated. Prices rise too quickly, expectations become unrealistic, and leverage builds throughout the financial system. Eventually, even a small piece of negative news can trigger widespread selling. Healthy corrections help prevent this by gradually resetting market expectations. Silver has historically been one of the most volatile major assets. Unlike some investment classes that move steadily over time, silver often experiences dramatic swings in both directions. Large daily or weekly price changes are not unusual. Investors who are unfamiliar with silver's historical behavior may interpret this volatility as a sign that something is fundamentally wrong, when in reality it is simply part of how the metal trades. Understanding the difference between volatility and structural weakness is one of the most valuable skills an investor can develop. Volatility measures how rapidly prices fluctuate. Structural weakness, on the other hand, refers to deeper problems affecting long-term demand, market confidence, or economic conditions. A market can remain structurally healthy even while experiencing sharp price declines over short periods. Many investors become emotionally attached to price. When silver rises every day, optimism grows rapidly, confidence increases, social media fills with predictions of much higher prices. Analysts begin competing with increasingly aggressive forecasts. New investors rush into the market because they fear missing out. This emotional cycle often pushes prices well beyond levels supported by fundamentals. Once expectations become unrealistic, the market naturally seeks balance. Buyers become less willing to pay increasingly higher prices. Early investors begin taking profits. Short-term traders lock in gains. Selling pressure slowly increases until momentum begins to reverse. What follows is often a correction that appears frightening but actually restores healthier market conditions. One useful way to evaluate a correction is to examine the reasons behind it rather than focusing solely on the size of the price decline. If silver falls because speculative positions became overcrowded after an extended rally, that correction may actually strengthen the long-term outlook. If prices decline because industrial demand collapses worldwide, global economic conditions deteriorate significantly, or major investment demand disappears, the situation deserves much closer attention. Investor psychology plays a major role during every correction. Human beings naturally react more strongly to losses than gains. A relatively small decline often feels much more significant emotionally than an equivalent rise feels positive. This psychological bias causes investors to overreact during market downturns. Headlines amplify fear because negative news attracts more attention than calm analysis. Financial media frequently contributes to this emotional environment. During rising markets, headlines celebrate new highs and highlight optimistic forecasts. During corrections, the same outlets often emphasize panic, uncertainty, and worst-case scenarios. Investors who rely exclusively on headlines can easily become trapped in emotional decision-making instead of objective analysis. Experienced investors often ask a different set of questions. Has the long-term investment thesis changed? Have supply and demand dynamics fundamentally shifted? Are economic conditions permanently different? Has industrial demand collapsed? Has investment demand disappeared? If the answers remain largely unchanged, a correction may simply represent temporary price movement rather than a lasting change in trend. Market participation also changes during corrections. Short-term traders often exit rapidly because their strategies depend on momentum. Leveraged investors may be forced to sell due to margin requirements. Speculators who entered late frequently panic first because they lack confidence in their investment decisions. Long-term investors with clear strategies often remain more disciplined during these periods. Another important factor involves technical market behavior. Strong rallies often push prices well above long-term averages. Markets rarely remain extended indefinitely. Eventually, prices revisit previous support areas where buyers become interested again. These technical retracements are common across stocks, commodities, currencies, and precious metals. They do not automatically signal the end of a broader trend. Liquidity also influences correction behavior. During periods of intense optimism, buyers are plentiful and sellers become scarce. As momentum slows, this balance changes. More investors attempt to sell while fewer buyers step forward immediately. Prices adjust downward until demand returns. This process can occur quickly in silver because the market is relatively small compared to many other global financial markets. Global macroeconomic conditions deserve careful attention as well. Interest rate expectations, inflation trends, currency movements, manufacturing activity, and geopolitical developments all influence silver prices. However, not every negative economic headline permanently damages the bull market. Markets constantly process new information, adjusting prices as expectations evolve. Industrial demand represents a unique characteristic of silver. Unlike gold, silver has significant industrial applications across electronics, solar technology, medical equipment, automotive manufacturing, telecommunications, and numerous advanced technologies. Temporary weakness in manufacturing activity may reduce industrial demand for a period, but long-term technological trends often continue supporting broader consumption over time. Investment demand follows its own cycle. During periods of financial uncertainty, investors frequently seek assets perceived as stores of value. As confidence returns to traditional financial markets, investment flows may temporarily slow. These shifts do not necessarily eliminate long-term demand. They simply reflect changing market priorities at different stages of the economic cycle. Supply conditions are equally important. Mining production cannot usually respond immediately to changing prices. Developing new mines requires substantial capital, regulatory approvals, environmental studies, infrastructure investment, and years of planning. Recycling contributes additional supply, but it also depends on market conditions and available material. Because supply adjusts slowly, temporary price corrections often occur without major changes in physical availability. Another common misunderstanding involves expectations. Bull markets rarely deliver constant gains. Instead, they often progress through waves of optimism, consolidation, renewed buying, temporary weakness, and fresh advances. Investors expecting uninterrupted upward movement frequently become disappointed during normal consolidations. Patience remains one of the most valuable qualities in long-term investing. Markets reward discipline more consistently than emotional reactions. Investors who establish clear objectives before entering the market often make better decisions during periods of volatility because they are guided by strategy rather than fear. Risk management becomes especially important during corrections. Position sizing, diversification, realistic expectations, and adequate liquidity allow investors to navigate temporary declines without making rushed decisions. Those who invest money they cannot afford to leave untouched may feel forced to sell during unfavorable conditions. Historical market cycles demonstrate that corrections have occurred throughout nearly every major commodity bull market. Energy, agriculture, industrial metals, technology stocks, and precious metals have all experienced significant pullbacks before continuing longer-term advances. Context matters more than isolated price movements. Long-term investors also recognize that no indicator guarantees future performance. Successful investing involves evaluating probabilities rather than certainties. Every investment carries risk, and every bull market eventually ends. The challenge lies in distinguishing ordinary corrections from genuine structural deterioration. Economic indicators provide useful information but should not be interpreted in isolation. Employment data, inflation reports, manufacturing indexes, retail sales, consumer confidence, monetary policy decisions, and international trade all contribute pieces of a much larger puzzle. No single report determines the future direction of silver prices. Market sentiment surveys can also provide valuable perspective. Extreme optimism sometimes signals increased correction risk because most potential buyers have already entered the market. Conversely, widespread pessimism may indicate improving opportunities if underlying fundamentals remain healthy. Sentiment often reaches extremes near important turning points. Institutional investors and retail investors frequently behave differently during volatile periods. Large institutions typically operate according to predetermined investment policies, asset allocation targets, and long-term objectives. Retail investors are sometimes more influenced by recent headlines and short-term price fluctuations. Understanding these behavioral differences helps explain why markets can move sharply despite relatively stable long-term fundamentals. Discipline ultimately separates successful investors from emotional participants. Developing a consistent framework for evaluating corrections reduces the temptation to react impulsively. Instead of asking whether prices are falling, disciplined investors ask why they are falling, whether the underlying thesis has changed, and how current conditions compare with previous market cycles. Those questions often provide far more valuable insight than simply measuring the percentage decline from recent highs. Central banks have an enormous influence on global financial markets, and while silver is not directly controlled by any central bank, the decisions these institutions make can significantly affect its price. Many investors focus only on the physical supply and demand of silver, but monetary policy often shapes the environment in which precious metals either thrive or struggle. Understanding how central bank actions ripple through interest rates, currencies, inflation expectations, investor confidence, and global liquidity is essential for anyone trying to understand the long-term direction of the silver market. One of the primary tools available to central banks is the adjustment of benchmark interest rates. These rates influence borrowing costs across the economy, affecting businesses, consumers, governments, and financial institutions. When central banks increase interest rates to combat inflation, the investment landscape changes. Higher interest rates generally make savings accounts, government bonds, and other fixed income investments more attractive because they offer improved returns with relatively lower risk. As a result, some investors shift capital away from assets like silver that do not generate income. Silver is often described as a non-yielding asset. Unlike a dividend-paying stock or an interest-bearing bond, silver does not produce regular cash flow simply by being held. During periods of rising interest rates, the opportunity cost of holding silver increases because investors may earn higher returns elsewhere. This does not automatically mean silver prices must decline, but it creates additional competition for investment capital. However, the relationship between interest rates and silver is more complex than many people assume. Markets are forward-looking. Investors are not simply reacting to today's interest rates, they are constantly trying to anticipate future policy decisions. If market participants believe central banks are nearing the end of a tightening cycle, silver may begin to strengthen even before interest rates actually begin to fall. Expectations often move markets long before official policy changes occur. Inflation is another major factor connecting central bank policy with silver prices. Central banks generally attempt to maintain price stability by controlling inflation within target ranges. When inflation rises above those targets, policymakers often respond with tighter monetary conditions. Conversely, when economic growth slows significantly, they may reduce interest rates or introduce measures designed to stimulate economic activity. Silver has historically attracted investors during periods of elevated inflation because many view precious metals as a potential store of value. If inflation erodes purchasing power, tangible assets sometimes become more attractive than cash. However, what matters is not only inflation itself, but also how effectively central banks are perceived to be managing it. If investors believe inflation will remain under control, demand for precious metals may weaken. If confidence in monetary policy declines, investment demand for silver can increase. Currency movements also play a vital role. Silver is commonly priced in US dollars in international markets. When the dollar strengthens significantly against other currencies, silver often becomes more expensive for buyers using foreign currencies. This can reduce international demand and place downward pressure on prices. Conversely, a weaker dollar may make silver more affordable globally, potentially supporting higher demand. Central bank decisions influence currency values through interest rate differentials. If one country's central bank raises rates more aggressively than others, its currency may strengthen as investors seek higher returns. These capital flows can have meaningful effects on commodity markets, including silver. Liquidity is another concept that deserves careful attention. During periods of accommodative monetary policy, central banks may increase liquidity within the financial system through lower interest rates or asset purchase programs. Greater liquidity generally encourages investment across a broad range of assets. Stocks, commodities, real estate, and precious metals may all benefit when financial conditions become easier and capital is readily available. When liquidity is withdrawn through tighter monetary policy, financial conditions become more restrictive. Borrowing costs rise, credit availability may decline, and investors often become more selective about where they allocate capital. This shift can temporarily reduce enthusiasm for speculative assets and influence silver prices even when long-term fundamentals remain positive. Market confidence frequently depends as much on communication as on policy itself. Central bank officials carefully choose their public statements because financial markets analyze every word. Press conferences, policy statements, speeches, and meeting minutes are scrutinized by investors searching for clues about future decisions. Even subtle changes in language can trigger significant market reactions. For example, if policymakers suggest that inflation risks remain elevated and additional tightening may be necessary, markets often adjust immediately. Bond yields, currencies, equity markets, and precious metals can all react before any official rate changes occur. Silver investors therefore pay close attention not only to policy actions, but also to expectations created through central bank communication. Another important consideration is real interest rates. Real rates represent nominal interest rates adjusted for inflation. Many analysts believe real rates provide a more meaningful framework for evaluating precious metals than nominal rates alone. If inflation rises faster than interest rates, real rates may remain low or even negative. Under such conditions, holding cash becomes less attractive because purchasing power declines over time. This environment has historically been supportive of precious metals in many market cycles. On the other hand, if central banks successfully raise real interest rates by increasing rates while inflation falls, competing investments may become relatively more attractive. Investors evaluating silver therefore monitor both inflation data and interest rate decisions rather than focusing on either factor in isolation. Economic growth expectations also influence central bank behavior. Strong economic growth may encourage policymakers to maintain tighter financial conditions to prevent overheating. Weak growth may lead to more supportive measures aimed at encouraging investment and spending. Silver occupies an interesting position because it functions both as a precious metal and an industrial metal. Economic slowdowns can reduce industrial demand while simultaneously increasing safe haven investment demand. The balance between these competing forces often determines market direction. Global coordination among central banks can amplify market effects. Although each institution pursues domestic objectives, financial markets are interconnected. Major policy shifts by leading central banks frequently influence global investment flows, exchange rates, commodity prices, and investor sentiment. A coordinated tightening cycle across several large economies may create stronger headwinds for silver than isolated policy actions by a single country. Debt levels present another long-term consideration. Governments around the world carry substantial debt burdens, and higher interest rates increase the cost of servicing that debt. Some investors argue that central banks may eventually face pressure to adopt more accommodative policies if debt servicing becomes increasingly difficult. While such outcomes remain uncertain, these debates influence expectations regarding future monetary policy and, by extension, precious metals. Financial stability concerns occasionally require central banks to balance competing priorities. Policymakers may wish to reduce inflation while also maintaining stability within banking systems and financial markets. Unexpected stress in credit markets or financial institutions can alter policy trajectories. Investors recognize that monetary policy is rarely straightforward and often involves difficult trade-offs between inflation control, employment economic growth, and financial stability. Silver investors should also distinguish between short-term market reactions and long-term structural trends. Immediate price movements following central bank announcements may reflect trading algorithms, speculative positioning, and rapid adjustments in market expectations. These reactions do not always determine longer-term direction. Sustainable trends typically develop as economic data either confirms or challenges prevailing expectations over time. Another factor worth considering is market positioning before major policy announcements. If investors overwhelmingly expect aggressive tightening, much of that expectation may already be reflected in market prices. When the official announcement matches expectations, price reactions can be relatively muted. Conversely, unexpected policy decisions often generate larger movements because markets must quickly adjust to new information. Investor psychology becomes especially important during periods of monetary uncertainty. Confidence, fear, optimism, and caution all influence investment decisions alongside economic fundamentals. Precious metals frequently experience increased volatility as investors reassess risks associated with inflation, currency stability, and broader financial conditions. Diversification remains an important principle regardless of central bank policy. No single asset performs well under every economic scenario. Investors often allocate capital across multiple asset classes to reduce overall portfolio risk. Silver may play different roles depending on individual investment objectives, risk tolerance, and economic expectations. Long-term demand for silver also extends beyond monetary considerations. Industrial applications continue expanding across renewable energy technologies, electronics, medical devices, advanced manufacturing, telecommunications, and other sectors. While central bank policies influence financial markets, technological innovation and industrial consumption contribute additional layers of support that operate independently of monetary policy decisions. Supply constraints further complicate the relationship between policy and prices. Even if tighter monetary conditions temporarily reduce investment demand, limited mine production growth or strong industrial consumption may offset part of that weakness. Successful market analysis therefore requires evaluating monetary policy alongside supply dynamics, manufacturing activity, technological adoption, and investor behavior. Historical market cycles demonstrate that silver has experienced both strong advances and significant corrections under a variety of monetary environments. No single indicator consistently predicts future performance. Instead, investors benefit from examining multiple variables simultaneously while remaining flexible as new information becomes available. Risk management remains essential because monetary policy can change unexpectedly. Economic data releases, inflation reports, employment figures, geopolitical developments, and financial market conditions all influence central bank decision-making. Markets often react rapidly to new information, making disciplined investment strategies more valuable than emotional responses to individual headlines. Careful investors continuously reassess assumptions as conditions evolve. Rather than relying on fixed predictions, they monitor how inflation trends, real interest rates, currency movements, economic growth, industrial demand, investment flows, and central bank communications interact within the broader economic landscape. This ongoing evaluation helps distinguish temporary market noise from more meaningful shifts in the environment affecting silver prices.